Your 401k does not drop 40% if the market drops 40%. Most of it does. Some of it barely moves. And for about 11% of the people watching this, a 40% crash would actually be the best financial event of their adult lives if they don't ruin it. That's the part the fund industry will never put in a brochure. And I'm going to show you the exact math in the next few minutes. Americans held $10.1 trillion in 401k plans as of December 31st, 2025. A 40% drop tomorrow. That's $4 trillion gone in a single day. To put that in perspective, that's bigger than the entire GDP of Germany disappearing from retirement accounts before you finish your morning coffee. And here's the thing most people miss. How much of that $4 trillion affects your retirement has almost nothing to do with the size of the drop and almost everything to do with a single variable that almost nobody talks about: your position on what I call the departure board. I want you to picture an airport departure board. You know the one, the big flipboard with all the flights. Some flights are departing in 12 minutes. Some aren't leaving until tomorrow morning. Now imagine a storm rolls in and every single flight gets delayed by 2 hours. For the person who has a connecting flight in 45 minutes, that delay destroys their entire trip. For the person who isn't flying until 6 a.m. tomorrow, the delay is irrelevant. They don't even notice it. They're at the bar. Same storm, same 2-hour delay, completely different outcomes based purely on where they are on the departure board. Your 401k and a 40% market crash work exactly the same way. I'm going to prove that with real numbers. And then I'm going to show you why the departure board metaphor has a hidden trap that even smart people fall into. Because the delay isn't the only problem. How you react to the delay is where most people actually lose money. In a few minutes, I'm going to show you the number that made me genuinely angry when I first found it. The one that explains why 2 people can retire with the exact same 401k balance, get hit by the exact same crash, and have completely opposite financial outcomes 20 years later. But first, let me explain why a 40% crash is basically free money for one specific group of investors, and why the financial media never talks about it. Gen Z currently has an average 401k balance of $13,500. Millennials sit at $67,300. Gen X sits at $103,952. Let's focus on the millennials and early Gen X crowd. You're 30 to 45. You've been contributing for a few years. You have a meaningful balance, but you also have 20 to 30 years of contributions left to make. A 40% market crash hits your balance. Let's say you have $100,000 in your 401k. That becomes $60,000 overnight. And here's where the math turns into something almost nobody explains clearly. Every contribution you make after that crash is buying shares at 40% off. Your payroll deduction doesn't know the market crashed. It shows up like clockwork every 2 weeks, automatically buying more. You are the person who shows up to the store the day after a 60% off sale and gets to buy at those prices for months, maybe years. The 2008 crash was genuinely the best thing that happened to 25-year-olds who kept their 401k contributions running. Their money was buying shares at 50 cents on the dollar that were worth $4 or more by 2024. The investors who panicked moved to cash and stopped contributing locked in those losses and missed the entire rebound. Fidelity found that savers, starting with $100,000, who stayed invested in stocks, kept contributing and rebalanced annually. From 2022 to 2025, ended up with $191,463. The saver who got completely out of stocks and stopped contributing would have had just $105,586 at the end of 2025. Same starting balance, same 3-year window, $86,000 difference because one person panicked and the other treated the crash like a clearance sale. This is where it gets really interesting because the departure board has a sinister flip side that nobody on financial Twitter will explain because it's depressing and depressing content doesn't get clicks. Stay with me because this next part changes everything about how you think about the timing of a crash. The year is 2026. There's a guy I'll call Marcus. Marcus is 61 years old. He has been contributing to his 401k for 33 years. He has built what feels like a fortress. The average balance for Americans in their 60s sits around $1,228,196 in total retirement assets, though the median is closer to $568,000. Let's say Marcus is at the median, $568,000. He's planning to retire next year. He has a specific date in his head. His wife has a specific date in her head. They've talked about it. His daughter's wedding is in October. Everything is aligned. The market drops 40% tomorrow. Marcus's account goes from $568,000 to $340,800 in one day. He loses $227,200 on paper. The crucial question is, what does Marcus do next? Here's the brutal truth that most financial advisors gloss over, because it's uncomfortable and it makes clients question the whole system. You think the problem is the crash. The actual problem is what happens when you start withdrawing from a portfolio that just got hit. This is called sequence of returns risk, and it is the single most underappreciated concept in all of retirement planning. Not because it's complicated, because it's psychologically uncomfortable to confront. Sequence of returns risk refers to the danger that poor market returns in the early years of retirement can permanently damage your portfolio. Once withdrawals begin, losses hurt more because you're selling assets at lower prices and have less capital left to recover when markets rebound. Let me give you two scenarios with identical numbers, because the numbers are where this gets genuinely unsettling. Retiree A and retiree B both have $1 million. Both withdraw $50,000 a year. Same average annual return over 30 years. The only difference is the order of those returns. Retiree A gets good years first, then hits a crash late in retirement. The retiree who encounters strong returns early and a bear market later finishes with more than $3 million after 30 years of withdrawals. The retiree who faces negative returns first and then recovers sees the entire portfolio depleted by year 27. Same average return, same annual withdrawal, $3 million versus zero. The only variable is the timing of the bad years. This is not a theoretical exercise. Consider a retiree who began their retirement in 1966 with a $1 million portfolio invested 40% in stocks and 60% in bonds. Despite an impressive average annual return of 9.5% from 1966 to 2000, this retiree would have run out of money before age 90 if they followed the 4% rule. Because the poor market performance and high inflation in the early years of their retirement significantly depleted their portfolio, and even the strong returns of the 80s and 90s couldn't make up for it. 9.5% average return. Money ran out anyway because the sequence was wrong. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now you're asking yourself, wait, I've been told the 4% rule is the gold standard of retirement planning. I've heard financial advisors repeat it like scripture for 20 years. And now you're telling me it failed a specific retiree despite near double-digit average annual returns? Yes, that's exactly what I'm telling you. The 4% rule is the most confidently wrong piece of conventional wisdom in personal finance. If a retiree starts with $1 million and follows the 4% rule, withdrawing $40,000 in the first year, a 30% market drop would reduce their portfolio to $660,000 by year end. This 34% decline severely impacts the portfolio's ability to recover, even if markets rebound in subsequent years. Continuing withdrawals from a diminished balance increases the risk of running out of money, illustrating how early losses can undermine the sustainability of the 4% rule. A 30% drop does that. Imagine what a 40% drop does. Let's do the math. You retire with $1 million. Market drops 40% the week you start withdrawals. Your account is now $600,000. Your 4% withdrawal is still $40,000. But now that $40,000 represents 6.7% of your remaining balance, not 4%. You've instantly broken your own rule without changing anything you were planning to do. The math has rewritten itself under your feet. And here's the part that should make you genuinely uncomfortable about the current moment. Despite extreme market volatility last year, especially in the spring of 2025, the average 401k balance rose by 11% to $146,100, marking the third consecutive year of double-digit gains. 3 consecutive years of double-digit gains going into 2026. Everyone's departure board looks great. Everyone's account statement looks great. And that is precisely when the concept of sequence risk is most dangerous. Because the higher your account has climbed on paper, the more you have to lose if the crash catches you at the wrong moment on that departure board. Here's the part that never makes it into a retirement calculator. You can watch this video, understand every number I've just shown you, and still not change anything. That's the gap. Knowing the risk exists and building a systematic defense against it are 2 completely different things. I spent years accumulating research on retirement data before I could build an actual framework around it, not just understand the problem in theory. I built a digital book called The Exit Code. It's 8 chapters of analysis built on 50 years of actual retirement data, not opinion, not general principles, but the specific mathematical conditions under which portfolios survive versus get depleted. Given what we've just discussed about sequence of returns risk, 2 sections will hit especially hard for you. The first is the dynamic withdrawal method, which replaces the 4% rule with a system that adjusts your withdrawal rate based on what the market actually does in your first 5 years of retirement, not what it was supposed to do. It's the difference between a static rule written in the 90s and a living system calibrated to actual conditions. The second is the lazy portfolio construction, the specific allocation that has historically outperformed active traders over 30-year windows, including through every major crash since the 80s. Not because it's aggressive, because it's built to survive the departure board problem at every stage. The book is built on 50 years of data. You can get it for less than 1 dinner out through the link in the description. Every year you delay the math on this compounds against you. And that's not marketing language. You've just seen the sequence risk numbers yourself. Now, here is something I want you to sit with before we go to the next section. Because there's a subplot developing here that most people ignore until it's too late. Go back to Marcus from before. $568,000, planning to retire at 62. But here's the part I didn't tell you about Marcus. In 2023, Marcus took out a 401k loan to help cover his son's wedding. $40,000. The loan is being repaid through payroll deductions. That money, the $40,000, is no longer invested. It's sitting outside the market, earning nothing, while the market ran up through 2024 and 2025. And because Marcus's loan balance represents money that's outside the account when the crash hits, it doesn't benefit from the dip the same way. Data from Bank of America shows that roughly 2.3% of participants had an outstanding loan against their retirement plan by the end of 2025, with average loan amounts of $9,300. It sounds small, but factor in the psychological layer because the loan repayment is happening through payroll deductions. Marcus doesn't feel the pain of it every month. He doesn't see it as part of his risk exposure. And that blind spot is exactly the kind of thing that compounds when a crash arrives. Marcus's story doesn't end at the crash. We'll come back to Marcus. Now let's talk about the decision that destroys more retirement wealth than any market crash in history. There's this interesting psychological phenomenon that happens in the first 3 to 5 days after a sharp market decline. Researchers call it the availability heuristic in reverse. You've watched your account statement shrink by a number large enough to feel physical. And the brain, which is extraordinarily bad at probabilistic thinking, starts treating the most recent information as the most predictive information. The crash feels permanent. The recovery feels theoretical. And that's when people pick up the phone and call their broker and say, sell everything. This move has a name. And the name is the most expensive mistake in American retirement history. Missing just the 10 best trading days over 20 years cuts annualized returns from 10.5% to 6.2%, according to JP Morgan data. And 7 of the 10 best days occurred within 15 trading days of the 10 worst days. Read that again. 7 of the best 10 days happen within 15 trading days of the worst 10 days. When you panic, sell, and move to cash, you don't miss the crash. You've already experienced the crash. What you miss is the recovery. You sit in cash through the 7 best days of the next 2 decades, and then you buy back in later, higher, after the fear has passed, which means you bought high, sold low, and missed the best days. You've done everything the academic finance literature tells you not to do, and you've done it in exactly the order that maximizes damage. Here is the pattern from every crash since 1987. Every crash since 1987 recovered to new highs, no exceptions. Recovery time from trough to prior peak has ranged from 5 months in the 2020 COVID crash to 86 months in the 2000 dot-com bust. The average across all 5 major crashes is approximately 41 months. 5 months on one end, 86 months on the other. That's a massive range. And here is the dark irony of that range. The COVID crash recovered in 5 months, partly because the Federal Reserve injected an extraordinary amount of monetary support into the economy in a way that may not be available in the same form in the next major crash. The 2020 recovery is an outlier, not a template. The S&P 500 declined about 34% from peak to trough between February 19th and March 23rd, 2020, but rebounded sharply within months and reached new highs within the same year. That speed was unprecedented. Planning your crash response around that timeline is like planning your road trip around the assumption that every gas station will be fully stocked and open at 2 a.m. So, what does a realistic 40% crash actually look like inside your account? Here's the part you came for. Let's break down the departure board into 3 specific groups with real numbers. Group 1 is 30 to 45 years old. You have between 20 and 35 years on the departure board. Fidelity reported that the average 401k balance dropped 19% between the fourth quarter of 2019 and the first quarter of 2020, and the market had dropped 34%. Notice the gap, 19% account drop on a 34% market drop. Why? Because most 401k accounts at that age have a mix of equities and bonds that cushions the fall. Most 401k accounts hold about 2/3 of their assets in stocks or stock-based target date funds. Bonds reduce some of the losses, but history shows that sharp declines still occur. So a 40% market drop for a 35-year-old with $100,000 in their 401k, assuming a roughly 70% equity allocation, produces a loss of approximately $28,000. That account goes from $100,000 to $72,000. And then this is the crucial part. Every single paycheck contribution you make from that day forward is buying shares at a discount. If you contribute $500 a month and the market is down 40%, you are effectively buying what used to cost $500 for $300. Vanguard's 2025 data shows that participants who stayed the course through multiple downturns saw balances grow 10% year over year on average. For Group 1, a crash is a gift wrapped in a terrifying account statement. Group 2 is 50 to 58. You're in the middle of the runway. Enough time to recover, not enough time to be reckless. The 40% crash hits differently here. Mid-career employees in the 45 to 54 age range saw sharp 401k declines during 2008, ranging from an average loss of 18% for those with between 5 and 9 years on the job to 26% for workers with a job tenure of 20 to 29 years. The longer your tenure, the bigger your account, the more you feel the crash in absolute dollar terms. Someone with a $400,000 account in this age group could lose between $72,000 and $104,000 in a year like 2008. Here's what nobody in this age group wants to hear. You have enough time to recover, but only if you don't touch the account. 401k participants on the verge of retirement ages 56 to 65 had average balance changes during the 2008 crisis that varied between a positive 1%, short tenure individuals, to more than a 25% loss for those with long tenure of more than 20 years. The people who lost the most in absolute terms were the people who had accumulated the most. Because they had the highest equity exposure and the highest account balance, the portfolio is both the weapon and the target. Group 3 is 59 and over, already drawing down or about to. This is where the crash becomes genuinely dangerous. Not because the percentage drop is larger, because the withdrawal machine is already running. The comedian in the room. Imagine telling someone who just retired last Tuesday that the market dropped 40% last Thursday. At first, they think you're talking about football scores. This is where we get to the real threat. And it's not the one on your account statement. Withdrawing from your 401k before age 59 and a half triggers a double hit, ordinary income tax on the full amount plus a 10% early withdrawal penalty. But the hidden cost is even larger, the lost decades of compound growth. But here's the thing about Group 3. They're often past 59 and a half. So the 10% penalty is off the table. They think they're in the clear. They are not. Because the real punishment for Group 3 isn't the early withdrawal penalty. The real punishment is being forced to sell shares at crash prices to fund your living expenses. You don't have the luxury of waiting for the recovery. You need money this month. Your mortgage is due. Your health insurance premium, which for people who retire before 65 and before Medicare eligibility is already eye-wateringly expensive, is due. You sell, and when you sell at crash prices, those shares are gone. When you pull income from a portfolio that's taken a big hit, you're forced to sell more shares at rock bottom prices to get the cash you need. This isn't a paper loss anymore. You're locking in those losses for good. Worse, you're crippling the very engine that's supposed to fund the next 20, 30, or even 40 years of your life. The shares you sold at a discount can't participate in the eventual market rebound. Now here's the kicker that I promised you. The number most people use to evaluate their retirement readiness is their 401k balance. Marcus looks at his account and sees $568,000 and thinks, I have $568,000. He does not have $568,000. He has never had $568,000. That number is pre-tax. Every dollar that comes out of a traditional 401k is taxed as ordinary income. Someone in the 12% bracket loses about 27% of a withdrawal to taxes and penalties. At the 35% bracket, nearly half the withdrawal goes to the IRS. So Marcus's real number, the actual spendable wealth, is somewhere between $350,000 and $460,000, depending on his tax situation in retirement. And now that crash just cut the nominal number by 40%, which translates to a real purchasing power loss that's even more brutal because the tax bite is applied after the crash. Marcus doesn't just lose 40% of $568,000. He loses 40% of the taxable pool and still faces the same tax rate when he withdraws. This is the second comedic cutaway. Your financial advisor will tell you, with complete sincerity, that your 401k is a retirement asset. He will not explain that the IRS is a silent co-owner of roughly a third of it. He will charge you 1% of assets per year to deliver this incomplete information. And here's where the subplot about Marcus resolves in a way that's instructive for everyone watching. Marcus had the loan. The market crashes. His account drops from $568,000 to $340,000. At the same time, because the company he works for starts cutting costs, Marcus gets laid off at 61. Not his plan, not his timing. He is pushed off the departure board before his flight was supposed to leave. He needs to file for Social Security early. Annual Social Security benefits are about 57% higher if taken at age 70, rather than starting them at age 62. Marcus, by filing early, locks in a dramatically reduced benefit for the rest of his life, on top of the crash damage to his 401k. This scenario isn't rare. Research shows that economic downturns cause an increase in the percentage of people who decide to retire, equivalent in effect to a negative health shock or retirement incentives. A crash doesn't just damage your account. It sometimes takes your job at the exact moment it damages your account. That's the compound hit that no retirement calculator models, because no calculator can predict when you'll lose your job. But the data says it happens more often than anyone admits. Now, here is the mini case study I promised. Meet David. David is 61, senior engineer at a manufacturing firm, been contributing to his 401k since 1994. He has $520,000. His plan is to retire at 64, claim Social Security at 67, and use the 4% rule to cover the gap. 4% of $520,000 is $20,800 per year. His monthly expenses are $4,300. The math technically works, but barely. Market drops 40%. David's account, $312,000. His 4% withdrawal rule now generates $12,480 per year. He is $11,000 a year short of covering his expenses. His options? Go back to work, reduce spending by about 26%, or draw down at a higher percentage and risk depleting the account before he hits 67 and Social Security kicks in. Let's say David retires with his $520,000 and plans to withdraw 4% annually. If the market declines 20% in his first year, his portfolio drops to around $390,000, and his next withdrawal represents a larger percentage of what's left. That snowball effect can shorten his retirement horizon by years. Now scale that to 40%. The math doesn't get better. It gets catastrophic. But here's what David did right, and this is where the practical part of this video starts actually mattering. David had been putting 2 years of expenses in a separate money market account as a cash buffer. That's roughly $100,000 in liquidity outside his 401k. When the crash hit, David did not need to sell a single share. He lived off the cash buffer while the market recovered. He gave his equity portfolio 24 months to heal before he ever touched it. That buffer is the difference between a sequence of returns problem and a sequence of returns disaster. The 3 practical takeaways from everything I've shown you. 1. Know exactly where you are on the departure board before the next storm arrives. If you're more than 12 years from retirement, a 40% crash is your friend. If you're less than 5 years from retirement, you need to run the sequence of returns math on your specific withdrawal rate and be honest about how much you can actually lose without needing to sell. The number that matters isn't your account balance. It's how many months of expenses you can cover without touching a single share. If that number is under 18 months, you have work to do before the storm arrives, not during it. 2. The early withdrawal trap is not just about the 10% penalty. On a $50,000 withdrawal in the 22% federal bracket with a 5% state income tax, your net take-home is roughly $31,500. You paid $18,500 in combined tax and penalty, 37% of the withdrawal, plus lost decades of tax-deferred compounding on that principle. If a 40% crash tempts you to pull money out to stop the bleeding, you are adding a 37% haircut on top of the crash damage. You don't solve the problem. You guarantee a second worse loss. 3. The panic sell and the early withdrawal are the same brain making the same mistake. The brain that says sell everything is the brain that says take the money out before it drops further. Both decisions convert a temporary unrealized loss into a permanent realized loss. The market has historically recovered from every crash in modern history. Your retirement doesn't recover from selling at the bottom and paying 37% of the proceeds to the government. Research from JP Morgan shows that missing just the 10 best trading days over 20 years cuts returns from 10.5% to 6.2% annually. And those best days typically cluster immediately after the worst days. The people who hold the longest win, even if they win ugly. Marcus's departure board got scrambled by a combination of bad timing, a loan he didn't think about as risk, and a job loss he didn't plan for. David's story ends differently because David had a buffer and a plan that didn't depend on the market cooperating on a specific date. The difference between Marcus and David is not intelligence. It's not financial sophistication. It's whether they had a system built to survive the departure board problem before the storm arrived. Lazy investing built more fortune than crypto memes. And in 20 years, when someone asks you what you did during the big crash of whatever year it ends up being, the correct answer is, I did nothing. I contributed my regular amount. I didn't touch the account. I let it run. That answer is boring, uncinematic, and statistically your best shot at retiring on your own terms. The financial industry makes money when you make moves. Think about whose interest is served by the panicked phone call to your advisor. It is not yours.